Hello, everybody. I have to introduce today Miguel Artola. He is professor in the Social Science Department of Carlos III in Madrid, and he is an economic historian who has been working on inequality for a long time. He met in Paris more than a decade ago, I guess, when he was a younger. Well, you have you need to leave some time for questions in the end. So go ahead.
Great, thank you. Thank you very much, Facundo. Thank you very much for everyone for showing up and for this invitation. I was kind of actually trying to remember. It was 10 years since the last time I was in London. COVID and many things got into it. What we are presenting today is a project that, in terms of the idea, it was born potentially about 4 years ago, but in terms of the draft and the paper, it was already presented last summer. And as always, we try to maybe be a bit too over-optimistic in terms of how much work we're going to be doing. So compared to previous versions, you'll see 1 or 2 changes, but not that much, because we're still kind of looking for an idea of what we are aiming to explain, especially on the mechanism. But just to provide like the main framework of the idea is that if you've been reading Branko in the last years, he's been arguing that in a way, 21st century capitalism is something different from what we typically have been reading, at least, or discussing as classical capitalism. And the main idea, I won't go into much into the details, that's basically a tailored graph that we do ourselves out of Branko's papers, basically to say, you can have 2 societies with exactly the same levels of income, with the same capital labor split, 70-30 is more or less what is embedded over here, with the same Gini, and nonetheless it's going to be very different. One society on the very extreme, in which basically capital income is only accrued at the very top, everyone else only earns labor, and what we typically nowadays think of, which is to say everyone earns a little bit of capital income, it's more concentrated at the top, it's not equally distributed. And therefore, this yellow area goes up to over here, and everyone also earns a little bit of labor. More labor at the bottom, but still a significant amount of labor at the top. And that basically, it's a feature that I do acknowledge that it hasn't been sufficiently studied, and how we move from one to the other is basically the core motivation of this paper. Now, there's a nice word that is now present, let's say, in our papers, which is this idea that in a way to easily capture this is through the concept of implotio, which again, Jonathan and Branko presented in a relatively recent paper. And it's basically the idea of, if you rank people first based on labor income, and then secondly, based on capital income, how much you get of an overlap at the very top. In this paper, we focus on the overlap at the very top of the top 1%, and mostly explain because it's due to methodological choices, but it also has to do with, in a way, the fact that since capital income is so heavily concentrated at the top, this is going to capture something very specific. So the overall idea is that if I think of myself, I may be, I don't know, back in Spain, in the top 10 of the labor income distribution, but I'm only in the top half of the capital income distribution. Therefore, the overlap is relatively small. If I was a CEO, most likely you will be over here. And if you are pure rentier, you're only here, but you're not over here. And it matters because, therefore, inequality of each factor income may not be as high as it was before the Second World War or at the beginning of the 20th century, but if there's an increasing overlap of these 2 factors, and increasingly the same people are both top labor income earners and top capital income earners, by definition, inequality is going to be growing into its dirt, which is basically the contribution made already 10 or 15 years ago by Piketty, Sides, and many others. And why it matters is potentially what we're doing. Now, it's not new. The late Tony Atkinson wrote what I think it's a very short but very illuminating paper, if it's a correct term, together with Lagner, basically on the association of basically capital and income, not simply on the previous definition, but in a broad sense, and that's why you basically have all these curves over here. I won't go into them. And in a way, I just presented it because it's also going to be our main paper which we dialogue with. And now bear in mind that what Atkinson and Lagner were doing was researching on the United States, using mostly tax microdata, as I'll present also in a minute, but starting from 1962. The main argument is that since the 1980s, it was moving towards a level of increasing association between capital and labor, but there's still something to be explained, and it's mostly something that I won't explain in this paper because it goes beyond, which is something that goes around in the 1970s, which is all these blips that you see over here, which would emphasize that it doesn't mean that it's a straight path, let's say from 1960s to today, this association, but rather more like a roller coaster that eventually ends up higher levels, but not necessarily all across, increasing all across the board through this period. So it's a slightly different perspective, but overall, I would say that it's mostly on the same framework. And then, of course, the main, what I take as the main result of Jonathan and Branco's paper, more recently, which again, it's based on the United States. And I always like to emphasize what they say, if I read it correctly, which is to say, compared to the previous paper, they can go back to 1950 using what is basically called the Survey of Consumer Finances, a drafted version of the augmented version provided a few years ago, which builds on the present day plus the historical data. And the starting point will tell you, if you take not the association at the top 1%, but on the top 10%, again, on this idea of where are you in the labor income distribution, where are you in the capital income distribution, and if you are the same person in the top of the two distribution, in the top 10%, we are having basically an association nowadays at about 30%. So 30% of top 10% capital earners and labor earners are the same people, but back in 1950, it was only 10%. And there was a selling point of that paper that I always like to call, which is to say, it's basically saying that it's random. Because if the association, if it's the top 10 and 10%, it's on both distributions, basically saying that if you randomly pick a top labor earner, you'll find a top capital earner, but that's basically, it's randomness. It's not negatively associated, but it's basically random, which is a nice selling fact. And as you can see over there, it increases throughout this period. In a way, as you'll see, we challenge mainly that assumption from 1950 and before. We are not going to question that much what goes up afterwards. From 1980s later.
This plot is the same probability as in the previous plot?
It's not exactly the same, because if you go to the Atkinson paper, what he typically likes to do is to present basically two associations, but not necessarily on the same share. So for example, some of these lines may refer to the top 5% in the capital income distribution and top 1%. What I think, yeah.
I think the following.
And this one, it's always top 10 to top 10.
But the drop in the 60s, 70s is seen in the SCF.
Yeah, this drop is relatively similar to this drop over there.
But not in the US Paris data.
But not in the US?
In the DINA data.
But not in the DINA data, that's correct. Because then the DINA data gets you everything about corporate profits, which is typically not reported in the Survey of Consumer Finance and in household surveys, which is the least. So there's always, I get more or less, if I understand or I get into Facundo's, which is the income definitions are going to vary and they play a role later into how we frame our results. Let's simply think that over here, there's eventually different definitions of income. And by definition, it's going to be different rankings in terms of labor and capital income.
I understand, but the US DINA data, what they do is they put the capital incomes from the national accounts at the top.
Yeah.
Totally,
Yeah,
Fed is like that.
Yeah.
So with that, they break the association.
Yeah,
This is totally a statistical artifact. You cannot conclude anything from the DINA data breaking this pattern in the 60s, 70s, because what is done is mechanically imputing capital income at the top.
Yeah.
But just
on
this, the timing here, though, seems more consistent with the dip in the DINA and LIS data than it does in the STF data, right? The dip here is between 80 and 85. And if you go to the other one,
I mean, I'm later going to zoom in this graph and will mostly focus on the bottom, on the last line over here, which is the association of the top one. basically the decline already started by 1970 and it bottoms in 1980 and later recovers.
But the SCF has a pattern that is a big dip somewhere else.
And there's an issue with the data, which I agree, which is not purely speaking, because then the SCF really starts dropping before, let's say by the early 1960s, and really has what I would call a bit of a abnormal result at the beginning of the 1970s. And what happens if you read now, there's increasingly more and more papers being used on the SCF, and some people are saying maybe the SCF has something about, I don't know, the representatives in terms of age groups in the 1970s. So my feeling is that we still have to work a little bit around with this data over here. I would argue that this result over here, which is, let's say, my starting point, is not mostly about the sampling, but on the definition of what we define as capital and income. So if I then move, let's say, one step back before we go again to the data, is to say, okay, classical capitalism is the kind of thing that I always love to teach in class. It's very beautiful to think of this 19th century capitalism, and it was presented by Smith, by Marx. It's very nice, but it's true that in a way, it's a time in which we don't have as good microdata as we have now. Nowadays, we have much more microdata or data than we used to have, but still it's not that we have tested with 19th century data this hypothesis in the 19th century. That would be my first. And then the second point, which is I think that, again, in business studies, everyone knows Berlin means, which is to say, already by the beginning of the 20th century, some people were saying the United States, the classical view on capitalism is no longer over there. And he was basically arguing corporate management and corporate ownership is increasingly divorced. Corporate ownership is increasingly dispersed as there's many shareholders. There's no single controlling shareholder in most modern corporations. That was the main statement by Berlin and Means. And additionally, corporate managers, which are the persons running these corporations, are overall having relatively few shareholders, which in a way is what we tend to think nowadays when we think about the stock market and who owns the stock market. They were basically saying that this is already happening in the United States 1930s. And there's been a huge debate about this. Some people actually say in Britain, before the First World War, you already had these features, which is worth acknowledging because the war doesn't start in the United States. And Britain had a very successful financial capitalism to speak of before even that started. So this argument is relevant because maybe it means that the complexity of the pre-World War I era was much larger than what these people tended to think, again, because they were probably writing even before the rise of the modern corporation as it happened through the late 19th century. Now, to us, let's say we take in a way this hypothesis, but then let's say basically one thing. Now, there's nothing contradictory with the fact that you can have, let's say, a managerial society with huge wealth and income inequality. That's something I think that the first people that were arguing this way, they were kind of confusing things. You can have a dispersed ownership of these US stock corporations, but then at the end of the day, since people have diversified portfolios, wealth and income inequality can be extremely high. And in a way, it's more or less what's happening nowadays in Western societies. But it does still pose a few things, which to me, it's like this basically captures the whole point of this paper. And I would argue we are halfway through in terms of explaining it. On the one side is, if you are extremely rich, and rich basically meaning high capital income, why care on working? If you're sufficiently rich as to, let's say, sustain a high standard of living, why you should work? And if there's been a shift from, let's say, classical era capitalism to today, why this has happened? Which I think hasn't fully been explained. Is it based on incentives? Because, I don't know, you get an extra few dollars of income. It is about status. Is it that status has changed? And again, in Britain, it's much easier to explain because let's say this idea of the gentleman is much more embedded at the beginning of the 20th century. It has disappeared and it's no longer acceptable, let's say, to be simply and purely a rentier. You have to kind of work to be accepted in society, to carry certain status. And these things matter outside, let's say, the pew numbers or the pew dollars that are over there. And then the other point, and that's for tomorrow, I won't be here, but it's to say, why should we care about capital income for the rest of the population? So it's not most of what we're going to be explaining over here, but there's one or two snapshots at the very end that we try to capture over here, which in a way is saying this also matters to our understanding of capitalism, which is it's not going to change the condition in terms of the well-being, the economic status of the most of the population, but maybe going from a society in which there's simply put no capital income at the bottom or some capital income, which is different from zero, that matters. And then my final argument is to say all these things, let's put it in a restricted manner when we say about capitalism, because it's mostly about the Anglo-Saxon capitalism. What we now know is that basically the level of development of corporations was much more developed, sorry for the repetition, in the Anglo-Saxon world than outside of it. So if I was to be repeating this paper in France at this period, in Germany, in Spain, in Italy, whatever, you will have different results, basically because the level of development of corporations is far, far weaker, even absent or controlling by economic growth. So we're moving from this, which is basically the Gilded Era definition of, I just forgotten the Gatsby curve era, the Gatsby world, to something that is more or less, and I'm opening here a great event that you're going to have in June, when they're going to be presenting the recent book by Cedar and Slick, which is basically they argue that if you live outside the super top four rich list in the United States, most millionaires, most rich people in the United States nowadays, as wealth owners, are relatively precisely the kind of group that we'll be presenting today, which are people that are working in their own businesses, in relatively closely held businesses. So most of that discussion show up on June, which you have a great event over here. I'll be just reading the book from Madrid. So I'm going for the remaining half an hour trying to present the paper. Believe me, some parts are relatively easy to explain. And it's to say, basically, we try to explain everything before the 1960 and try to explain why it shifted potentially. We have one or two explanations, but it's mostly about describing why this matters. We do that leveraging on a specific data set from 1936. I'll try to explain why one single year can potentially be very illuminating in this respect. And we'll try later to argue that connecting the dots from 1936 onwards can mostly be done through census data, as I'll explain in a minute. And overall, the main finding is that everything that we have been discussing about homoplotio changes significantly once we go before 1960, in a way because it was not historically low, but rather, and here comes the surprising fact, at first, it actually peaked. So it was at the highest level in 1950, and there's basically a shift in the preference. And that before the before the Second World War, in 1936, it was already quite substantially high. So in a way, it's kind of dismissing this idea. And basically the shift from the 1936 to 1950 to everything that comes later is mostly driven by the fact that relatively capital owners and business owners, there's a big incentive from moving from the classical form of a corporation to basically a partnership or a business or closely held form of business association. Okay, I'll explain briefly the data over here. This could go for ages, but I've tried to condense it to the very shortest possible way. So why 1936? So the kind of nerdy people like Facundo and myself who just like to look into the tax data, we know there's one publication in the United States that up to today has been published, which is called the Statistics of Income. It's a very easy way to think about it, which is basically a tabulation by income brackets of people and their composition. That's the kind of thing that Piketty and Saez have been using for the last 20 years, and everyone the starting point of everyone. What we use in this paper is we keep this, let's say, in the back, but we use something quite unique, which is 1936, halfway into the New Deal administration, Roosevelt was kind of fascinated with the income tax and said, we cannot simply rely on this because this is partly a sampling of income tax returns. We have to actually tabulate every single tax return in the United States. At that time, about 5% of the population was filing tax returns. So it's about, I think, 4 million tax returns at that time. And this was done by actually a German scholar called Simon Kuznets at that time, together with Raymond Goldsmith. They published 2 volumes, which I'll show you in a minute. They later destroyed the microdata, which is terrible for us, but it's what we have. And we leverage basically on this, together with the fact that there's additionally, at the end of today's presentation, there's also this state income tax. And some states would leverage an income tax, such as Delaware and Wisconsin, which also provide you for this year exceptionally detailed tables. How does the data look like and why is it different? So it's different in the following manner. Imagine that all of us, for sake of simplicity, we were in a specific income bracket from, let's say, $100,000 to $200,000. If you were in the traditional income tax returns, they will tell you, so there's 50 people or 20 people, and we will have basically an income composition basically made up of the average of all the incomes of people over here. What they do in this table, which is different, is they say, okay, let's identify how many people have specifically certain combinations of income, right? Salaries, business, and dividends, or salaries, rents, and interest, or dividends, partnership, and whatever. So any kind of combination is kind of explained over here and detailed. So they tell you how many people earn 1 income source, 2 income sources, three sources of income, or 4, and which are they. That's the starting point. That's really helpful, as I'll try to explain later. And secondly, they always provide like kind of matrices, in which they say what's the size of one income source and the other one, playing constantly with this kind of information. So we'll tell you what's the size of salaries, for example, over here, and the size of dividends over here. And then additionally, so you can connect basically this kind of data over for one column with this one. You don't exactly know how the people are fitting into one versus the other, and we'll have to do one assumption in doing that at the following step. So the idea of this 1936 income tax project is basically to eventually provide you, all researchers, with a nice microdata that basically assumes the distributions that we're seeing from these 2 volumes. They should also match the SOI tabulations, the default standard statistic of income tabulations, and we also want to do things at least with some resemblance with the national account estimates, basically as a benchmark. And not everything is going to fall into the national accounts framework, but potentially some things should be relatively similar. Now, the main drawbacks, there's a time in which basically the filling threshold is $2,500 annually, which may seem low, but it's actually quite high. It's basically the top 5% of the population, which we are truly capturing well. There's people below this threshold, but we don't take them as representative because they are different filling thresholds. And the main challenge, which it's a bit tricky, is how you'd actually move from all these different set of tables and matrices into what you would call, or you would like to see as microdata. And I will explain relatively briefly by saying, so we typically have information on how many people receive 1, 2, 3, or 4 sources of income. Which are those, like for example, salary and interest. So we know how they fit into the total income distribution. Total income is basically summing one versus the other. And then we typically have a matrix of one versus the other. So I explain over here, and basically what we do is that we say, okay, for each, if we start with this matrix, we can typically estimate that if you add one and the other source of income, you can end up in a total income bracket of 1 or the next bracket. So you can have, let's say, salaries from 1 to 100, interest from 1 to 100. By definition, you should be in the total income bracket of 1 to 100 or $100 to $200. There's a level of uncertainty, and what we basically do is we impute, think about it as a matrix from the top left of the matrix, and we start distributing people so that they fall into this imputation and within these assumptions. And that's basically how we are doing, keeping this constraint and then imputing to the next bracket to fall into this constraint. The nice thing is that eventually there's no violation of the principle. You cannot have more income or less income that you would mathematically would have, but there's a level of uncertainty on whether you will fall in one or another income bracket overall. Let's say for now, that's mostly what we do. A last short explanation is that that's for 1936. Eventually, we'll have that data set because it will provide us with a nice snapshot of the top of the distribution, but we want to have things more detailed for later years. And there's a huge gap basically because the US tax microdata does not start until 1960, 1962. And in between, there's a few things that are worth catching. So we argue that you can actually rely to some extent on the census. So there's just so that you know the census, nice thing is that nowadays it's digitalized. You can download it with a single click. And you have both either samples or the full data of everyone counted in the census. Now, what's the data in terms of the income? So in 1940, it's only wages, and that's it. But in 1950 and 1960, wages, self-employment income, or what is called other income plus total income, is reported at an individual and household level. 1970 onwards, it does provide. Now, typically in the census, they cap or they code the data, and we have been matching or trying to play around, and basically it matches quite accurately until the top 1%, in which basically at this point they are capped at $10,000, and therefore you cannot know more beyond the top 1%. But as I'll try to argue later, more or less, it works reasonably well. And the census, the nice thing that we are not yet exploring is that it includes all the social demographic data that is typically absent in tax microdata. So in terms of the results, let's start with the basic idea. So in 1936, if we start with the total income distribution, and this is percentile 95 to 96, percentile 99, and this is the zooming up to the 0.001% of the population, you basically have the typical picture that you would expect. The more you go upwards in the total income distribution, there's less people reporting wages, which is the dashed red line. If you include, and here comes the main difference, business income as a mixed source of income with both labor and capital, and you assume basically that everyone who's a business earner is also a labor income earner, this moves slightly upwards, and the black line is basically capital income, which can be basically business or any other, interest, rents, partnership, dividends, whatever. Bear in mind this issue, which is this starts relatively low. So even in percentile 95, only 40% of those people, of those individuals, are reporting some capital income. Fast forward to 1960, and things changed quite significantly already there, in the sense that the most obvious one is that capital income is now much more prevalent. So it's now starts at about 75%, and it will rise up to 100% by definition. At the very top, everyone earns. Bear in mind that here we are not reporting any results because they are a bit strange, the microdata on the first year. But the second point is basically the moving up also of the capital income distribution, of the labor income.
If you control for age.
So there's no control for age.
I know there isn't any control. I just say, would you get the same?
So for that, you will have to use the tax census. But the overall idea is to say, I'll try to argue later, it would be very hard to be driven by age, because if anything, society is aging from 1936 to 1960. So you're getting more labor income at the same time. More people, in principle, reporting either wages or, most importantly, business income or partnership income. I'll try to explain why this can potentially happen as you move from over here. So the main idea that already here, the very top of the income distribution, 95% of them are reporting some kind of labor income. That will be the starting point of this, which was not the case over here in terms of total income, that was kind of plateauing at 70%, which is and I would hardly argue that can be explained by age, because if anything, it will be the other way around in terms of a declining trend, not an upward trend.
Sorry.
Yeah.
Just a quick follow-up. I think trying to get at the same thing as Tony, but how are pensions classified?
So pension, basically, in 1936, they are classified as other income, which we are not dealing about.
So it's not there.
It's not there. In 1960, they are, and we are basically counting them as part of labor income. But but even 1960 pensions are relatively a small item. It's because if pensions was the item, it would be part of the salary. So this because if you think about it, the big shift, the dashed line, changes slightly, but the main contribution is the fact that basically business income, which is basically people who own an unincorporated business or a partnership, has increased substantially from one year to the other. That's my main selling point. If it was pension, I wouldn't be disguising the data because it would be showing up in the tabulations one way or not. And here comes the point. So the whole homoplosia result, and to make things consistent with one source is one and the other one source is not, this is our nice data set from 1936. Everything here in the black columns is purely based on the census. And in the census, we are not using pension data in the sense that what we're basically doing is we have wages, we have self-employment income, which we divide 70-30, and we have other income, which we are only assuming that is purely capital income when it's at the top 1% level. So it's going to, these levels is more or less what we were previously discussing in the first set of graphs with this idea of a declining and again upward trend in the last decades. 1950 is actually the highest point. 1936 is relatively, let's say, comparable to things that we observed in 1970 and 1980. How does this match with the previous results? So black line is basically Lackner and Atkinson, purely based on tax data. The red points is purely based on our census data. So it's not exactly the same definition. Yes, for example, Lackner and Atkinson, I think that they do use capital gains. The census does not count capital gains. There's small things about the unit of observation, but overall the main point is that the two of them align relatively well in the missing point. And what we are adding from the census is this one, 1950, and then we say tax data will tell you this in 1936. That will be our main selling point on the consistency of these results. Now, why do the results differ from the previous paper I was commenting on? So, Jonathan and Branco do not provide, at least in the main results, the top 1 to top 1. I think because they basically argue that they're not aiming that the survey of consumer finances is represented at the very top. I think that no one argues that, but we still try to think about what potentially can be going over there. So there's potentially an argument about yes, there's an issue about top coding and how well a survey as opposed to a census is capturing the top of the population, but it's mostly about the definition. So in the definition provided in that paper, basically it's working around wages and self-employment income as one form of income versus everything else which is classified as capital income. And what we argue is that it's paramount basically to divide business income. What we are doing is basically the rough assumption of 70-30. And when you do that, this changes very substantially. It's basically arguing that pure business income in 1950 is actually one of the main contributors to overall labor and capital income at the very top. So everything that you do over here in terms of business income is going to give you a big difference in this definition.
I forgot what's on the vertical axis is the probability that you earn the 1% of labor conditional and being on the 1% top.
Yeah, that's it. So this means that what we're obtaining is that 1950 close to 40%, about 38%, it's on the same. So the black points, sorry, the red points is basically this one. What we are omitting, just for the sake of simplicity and the comparison, is the 1936 observation that is not present in this graph.
Because I was thinking of that, I missed your explanation for why it's so different from Branco and Jonathan's thing. What is that again?
Because what we do in our paper is anyone who reports business income, that business income is divided 70-30. 70% is classified as labor income, 30% is classified as capital income. And then we include those components into adding up.
And what do they do?
Basically, it depends on the previous definition. In one paper, in the DINA, for example, done in this way, but in the SCF, I think it's mostly accrued to labor income. I think so. And that's why
that blue series, it's
in the blue series, so if you count all self-employment income as labor income, by definition, the association is going to be lower. Because and that comes in the next slide. Imagine a typical thing that can happen. In the census, you can have someone exactly reporting $10,000 in self-employment income, which is actually the top code. If you divide it 70-30, that person most likely is going to fall into the top 1% of capital income because $3,000 of capital income is sufficiently high to place you at the top of the capital income distribution. And $7,000 is also most likely going to place you also at the very top. Maybe not at the top 1%, but conditionally you have any additional income from somewhere else. And that's the main point, which is what we are playing around is with this definition. If you do it the other way around, you just say those $10,000 is purely labor income, nothing else. Most likely, therefore, there's going to be no association. So it's mostly a story about self-employment income, what we're saying that matters for this gap over here. And that's basically what we do in this graph, which is to say, this is the 1936 tax data we have elaborated. Everything else is from the census, and we are basically saying, condition on what are you fitting in the top one. So it is because you have wages and capital income, and when we say capital income, it's the pure capital income, the interest, the rents, the dividends, the kind of thing that we tend to think mostly about it. That's the black area. The red area is the example I was giving a minute ago, which is if by definition your level of mixed income is sufficiently high that even when you separate it, you fit into the top 1% in both cases, you're in the red area. And the blue and the different blue areas is basically a combination of either mixed and pure capital income or any of the three. So it's basically, yes, going from here to here, it's basically a story of the expansion of the self-employment income from before the Second World War to after the Second World War, and basically arguing, which is also the key point, that this red area was almost small in the United States before the Second World War, and now most of the shifts that has been kind of puzzling, let's say, the previous discussion, are explained by that. So the book that will be presented in June speaks of this world in a way, but we are saying that kind of world was already existing in the 1950s. And there's something that goes around those people in the 1970s that most likely explains that decline around that time. And now my ending point will be the following, which is to say everything conditional. I think that this is a nice point, which is to say, okay, let's elaborate a bit more. So this is a typo, so it should be labor. So if you're in the top labor distribution, whether top 1, top 0.1, or top 0.01, is basically to put things in numbers, this is basically a CEO. This is a manager, and this is a professor, more or less, in the United States in 1936. How much or where are you in the capital income distribution? Top 0.1, top 0.01, top 0.1, top 1, or simply put, and here's my main thing I always like to say, simply earning $1 of capital income. So the main idea is that in 1936, you are already having a significant association. So for example, someone who is at the top 1 of the labor income distribution, 70% at least are earning $1 of capital income. 25% are already in the top 1% of this result. That's why it matches, and then it declines over here. It typically should be declining because by definition, now this is not especially surprising. This is to me the thing that, and this is 1936, 1962. If anything, it looks relatively similar. It hasn't changed that much, which is to say top labor incomes, earners tend to have some capital income. If anything, the $1 threshold is moving upwards, but the rest is not more associated from 1936 to 1962. The big shift is in the capital income distribution, which is to say in 1936, if you're in the top capital income, here comes my main selling point. Half of them report zero labor income. Zero is zero. Is that because we know those people from the tax returns? So the labor income or the wages of self-employment, it's zero. There's nothing whatsoever, then everything declines more or less in the same way. 1962, it's mostly this point that has risen up to a similar pattern. So it's not never going to be purely symmetrical. This graph doesn't look the same as this graph, which is what sometimes we miss. And I think that what Lagner and Atkinson try to emphasize is that this is not symmetrical, even if you measure it everything on the top 1 to 1. And that's the final point, which is if you take out the self-employment component and you basically are measuring the association between pure capital income, rents, interest, dividends, fiduciary income and things like that, there was a much higher association than afterwards, because afterwards, let's say all this component of business income matters. And here comes and what's the overall explanation? Well, last year, we published a paper in Explorations in economic history and basically argue why this matters. In a nutshell, and this is the main contribution from the paper, is to say, in the pre-Second World War era, most businesses in the United States were actually, most businesses of a certain size were actually corporations, because the corporate tax rate was relatively low. When I say low, it's 10 to 12%. In the Second World War, the tax rate for the corporate tax rises up to 50% and later declines. And what we basically say is this is the tax rate, and this is basically the number of corporations, the black line, which basically stagnates, if anything, declines slightly to the Second World War. And what really skyrocketed is the number of partnerships. And partnerships are basically mixed income. And that's basically going to continue later. And much of, let's say, the all never-ending discussions within the scholars is basically about the role of these kind of corporations, S corporations in recent times and things like that. So what we are saying is that this kind of shift was already taking place throughout the Second World War, and there's a shift in distribution. Now, I would say that that can partly explain, but doesn't explain everything because of this point. Because if it's simply a CEO transforming itself into a self-employed, he should be reporting wages in 1936, and he's not. So that's why I say that it's not only a tax shift strategy. There's something more going over, although just to make it evidently, the easy part has already been at least addressed partly by ourselves. So I'll finish off mostly with this one on the next slide by saying, if we later go back to the default statistics of income, the typical image that Piketty and Sayed have been framing is this one. If you focus on the top 0.1%, I forgot to put it that over here, capital income is still very important all across the period. It's not changing that one. And this is basically 1918, 1950. So yes, there's the 19 booms, there's the decline through the Second World War era. That's it. It's on the fact of whether you are earning. So it's basically saying salaries by definition are earned by salary earners within the top 0.1. Business income by business owners. And the yellow part, in a way, has to be captured by these people and partly by these people. It's an association of who earns what within the top 0.1%. The main idea is that people who only earn capital income at the very top of the overall income distribution without business income is basically reducing very significantly throughout this period until almost becoming negligible at the end of the period and basically continuing doing that. And it's that, and then just as a snapshot of what comes and is still pending is, what about the rest of the population? So if you rank people basically only on their salary, so this is, again, ranking in terms of the salary income, and saying how many of these people only earn their wage and nothing else. At the very top of the salary income distribution is basically zero in 1936, and that's not surprising. The red line tells you how much we can go further down the distribution of the salary income distribution, that is 97%. The nice thing about Delaware and Wisconsin is that, for example, in Delaware, you can go up to percentile 50 because almost everyone had to fill in an income tax form in Delaware. Now, Delaware is a small state, but it's basically telling you that what we tend to think of the average wage earner at that time, 80% of them is only earning a salary, and that's it. 1962, for the United States, the whole curve has gone downwards because people are starting to report these $10, $20 of capital income. And of course, much less so as you go towards the middle of the distribution, but still quite significant. So it's basically saying that this kind of popular capitalism, if anything, developed much more after the Second World War than before that. So to conclude, it's basically to say what we are challenging is what we think of homoplosia. It was already quite high before the Second World War, and it actually peaked in 1950 because of this feature of a shift in the preferred form of business association throughout this period. It basically shifts our perception. It can be partly explained by fiscal preference, but I would argue it can be purely explained by this shift in the tax form of businesses. And I'll leave it over here, and thank you very much.
Branko, start.
It's a great paper. Actually, I didn't understand everything, but I understood basically the story. So let me ask you, I have two questions. The original slide that you showed when you have 1936 data, you have, it seems, only the information if somebody is in the top, well, suppose somebody is in top 1% by labor income, whether he actually has any capital income.
Yeah.
So how do you derive the percentage of them who are also in the top 1% by capital income? Is it a derived number or is it a number that you, because it doesn't seem that you have that number.
So that what we always have at that age, so in 1936, very little people are filling a tax return. What we're basically saying is it's very difficult for us to derive anything below percentile 99. So we cannot obtain the result for the percentile 99 of the salary distribution, labor income distribution, and capital income distribution, because we know the number of people, adults basically, or married, or adults minus married wives in the United States. So it's basically saying, I believe the tax units in the United States, I don't know, are 50 million people, but we are observing are at least 5 million. And we are basically arguing that there should be non-filers below this level.
But if I'm sorry that I maybe repeat myself, but if you observe me with the wage income of X, which puts me in the top 1%,
yeah.
And the only other information is that you have that I have non-zero capital income.
Yeah.
How do you know that my capital income puts me also in the top 1%?
Because what we're basically doing is that, again, we are taking you and everyone else that potentially shows up in these income tax returns, we rank them by capital income, and we basically say, okay, any observation on top of $2,500, which is the minimum income threshold that is for filing a tax return, can be trusted. That's the more or less the one that, and that typically falls or makes your number of observations greater than 1% of the population. I don't know if I make mistake.
I was still, because I could have $1 in capital income.
Yeah.
And I would not be definitely in the top 1%.
That's it. That's basically moving from here to here.
But is it the information that you have, or is it information that you basically produce?
So this is basically information that we produce because we are producing a capital income distribution.
Okay.
It's a capital income distribution that we know for certain, we argue that know for certainty until the top 1% onwards, because it's what you will
So it's the model distribution.
A model distribution of the tax data by adding everything that we consider capital income in the tax returns.
And my second point is that actually the division of the self-employment income, you're using 70-30, and obviously the divisions are always arbitrary. But it is true that depending on this division, you would actually can generate many different results.
Yeah.
Because if you were to division 99-1 in favor of capital and labor, you would actually not find the association at all. Because let's suppose I'm rich in terms of labor and I'm rich in terms of self-employment, and you gave me 99% as labor, I would just remain as a rich laborer, but I would never become a rich capitalist.
Yeah.
So the very choice of the range there would influence the presence of homoplatia.
Yeah, definitely.
That's all. Okay.
Hi. So thanks a lot. This is really interesting, and I guess I need to read the paper in detail. But I have sort of 3 or 4 questions or comments. So first of all, I mean, on the business income issue, so I'm just saying that somewhere in our appendix there is kind of a comparison where what happens if we put all business income in capital income, what happens if we put all business income in labor income, and kind of there's 2 extremes, and see how, to what extent it changes the H1010. And I think the impact is not huge. It's not negligible, of course, but it's just a way to kind of bound these assumptions in terms of size. And related to that, also that H11 number, I mean, the SCF plus is indeed not a good source for that, but I think, again, in our appendix, maybe there is something using the Dyna series, and I would
Or
imagine
also.
sorry,
And lease.
yeah,
Lease as well.
and they would be very similar, I think, to what you show. So, or not, maybe not line on line, but they would be quite different from the SDF plus one. So I think, it's definitely in the appendix.
Yeah, no.
So now, two more points. So on 1950, I find this result really interesting because it's really counterintuitive to me, not only because the number is very high, but also because 1950 is somehow historically very low in terms of income inequality overall. Maybe not the lowest it's been, but let's say still already kind of very low after the World War and everything. And in a way, homoplutia, we know, is something that acts to increase inequality. So if homoplutia is very high and overall inequality, income inequality is very low, it means that every specific factor, the inequality of every specific factor has to be extremely low or like unusually low. And I think this is quite interesting. Like, has capital income distribution in 1950 that low? Because to me, it's a sort of necessary condition to kind of be in line with both high homoplutia and at least the stylus effect of very low overall income inequality. So if it's indeed the case, this is something really interesting to point out, because once again, I would expect high homoplutia to go with high inequality for the clear reasons of high income people kind of put together in a way that only kind of increases inequality relative to the uncorrelated case. And then the last point on 36. So the point that what you told Branko now, is it possible to, is it a matter of combinatorics, basically, that you have like a number of people in different kind of brackets, and then you can sort of make an assumption what happens. So you have two matrices sort of that you're trying to figure out together how they would translate into something that is close as possible to microdata. But I suppose there is no one-to-one way of doing that, right? You're making an assumption here. And I suppose my question is whether you can create bounds. Like, what happens if you make some assumptions that would make homoplutia the largest it can be, that is still consistent with these matrices, or the lowest it can be, still consistent with these matrices, and then have like a range of values? Because I imagine there is no one number you can kind of estimate for using these matrices. Yeah.
So if I can answer, please go ahead if you.
Oh, okay. These are questions from a non-expert. First of all, are we supposed to view this as sort of economic history paper, or is it one that you think is somehow relevant to current circumstances? The second question is, it prompts me to think about what is actually happening, the mixture of capital and employment income. There's two factors which strike me as being quite important at the top, at least. One is that so much people, for tax reasons, take equity in the companies rather than income, and so that itself, I don't know how important that is, but in terms of individuals that one knows about, that seems to be a very common thing at the very top of the income distribution. So much of their remuneration now is taken in the form of various share offers and things. The other thing is the reason why rich people maybe work these days, but very often it's almost manufactured work in a sense that they're looking after their own family finances, managing their own assets. In the past, they would have, if you're a farmer, for example, in the past, you would have just had a farm manager who did everything. These days, it's probably more likely that you take an active interest, and therefore you're recorded as having employment income. I mean, I don't know to what extent these sorts of factors, I mean, there may be lots of others that I haven't immediately thought about, but it strikes me, those are the questions which I'm prompted by this sort of work now, just thinking about what are the reasons, not just in the middle of the 100 years ago, but what are the reasons today? Is this still happening? For what are the reasons driving it? The other factor is what Chico said about pensions. I mean, amongst richer people in almost every country now that has, very established pension arrangements, a huge amount of their assets is allocated to pensions funds, and this is why the age issue then comes into because as people get older, they can easily have half of their total assets in the form of pension funds. So these are the questions which prompted by this, and I'm not sure that there's any connection between your sort of historical analysis and the sort of questions which would be more recent, perhaps.
So if I can answer the both set of questions, I mean, maybe I don't answer everything, but I will just start with your last. Like this economic history is something else. Now it's true that I typically don't start the paper, let's say, with this idea of I'm only speaking to historians of a bit more. Let's put it this way, that it's why do the rich work? The rich potentially are sufficiently engaging question as to think of today and 100 years ago. Because what you typically open a novel, Scott Fitzgerald, this kind of idea of 1920s is that the rich don't work for cultural reasons. Like this idea of the gentleman who doesn't work, I think that it's not very difficult to sell over here. But more if I was speaking to an American audience, barely an issue if I was speaking to a Spanish audience. And I think that that's something significant. Now, in overall terms, it's a tiny percentage of the population, doesn't matter, let's say, for our labor market models and things like that. But to me, it's sufficiently interesting as to speak, especially because it goes precisely counterintuitive to the overall trends in taxation. If anything, the standard model will tell you that high marginal tax rates will disincentivize rich people from working, and they're precisely doing the opposite thing. So that will be, let's say, my selling point to one non-economic historian in the audience. Now, what's going over here is, let's say, I would say that most of your questions in this research are answered by these people. And they basically argue that these things matter today, that the rich are not simply running family offices and disguising part of their income as salary. They basically argue through different ways that it's people who run relatively closely held businesses, and the main way that they like to test this idea is that since they can measure when someone dies and they can measure the income from that company, partnership or whatever after he dies or she dies, there's typically a huge decline, and that basically argues that there's definitely a contribution in terms of labor. And we cannot unbox the kind of mixed income today. The same question that you were posing a minute ago still apply to today, but they basically argue if this is purely passive income, the kind of Duke of Wellington dying 100 years ago should not affect the income of the state of the Duke of Wellington, would be my argument. And nowadays it is affecting as they measure it with the microdata. So my concern is to say I don't have to explain that much of the post-1980s world because some other people are working on that. I'm kind of trying to understand how we get into that. And instead of thinking of, it's actually quite a sudden move, I would hypothesize that takes place in the immediate aftermath of the Second World War, let's say in a reframing of the United States. And going back to Jonathan's question is to say, the question of 1950 is the following. Capital income, the pure capital income, the kind of thing that we're always thinking of, really declines, which is not shown in this graph because this is basically a composition, it doesn't tell you the share. But if you were putting this as a share of national income or whatever, the yellow part for this group or for the overall population will be at its lowest point. So that by definition is going to affect how you measure homophobia, because if this yellow part has really gone to the lowest level in the 20th century, the blue part, the light blue part, which is all this mixed income that was my starting, must definitely affect more than the pure capital. That would be my overall argument. And any kind of ranking is going to be heavily affected. If you forget about that definition, let's say, let's do something very simple, which is forget about mixed income, then you will get this. Which is to say, if anything, let's take simply out of the equation mixed income, then you end up with this, which is completely in opposite effect. That's what we tend to think, but that's the problem is that then an American scholar will show up over here and say, no, you cannot understand the rich without mixed income in the United States. It's simply impossible. It's so big and so heavily concentrated that it drives the results. So it's kind of saying that we have to, I think, I mean, it's a never-ending issue. What's the right percentage? I don't have it. We can play around with the paper. Yeah, we definitely have to play around with different percentages and thresholds. But conceptually, that's my point, that we always like to start with this graph because it's a nice thing to start off. But the problem is that in the 19th century, classical capitalism, if anything, the predominant form of income is mixed income. It's neither wages nor pure capital income. It's mixed income. So if anything, the problem is that we have to square things around in saying, I mean, if you travel to a developing economy, my intuition it will be again pretty much the same nowadays. So it's nice to always start with this idea, but we always have at the end of the day to square things out in this point. And yeah, I think I'll leave it over here, not to overburden you. There's things about pensions, which I do take. There's things about things have to be explained in this paper, which I'm not explaining. But I think that overall, there's something worth about connecting the classical era, pre-World War II era, to how we tend to think about these facts as they are very much researched from 1970 onwards. And I think that there's not so much. I mean, there's not so much unknowns from post-1980s. It's how you move from one to the other, which is yet fixed. I would add.
Well, thank you, Miguel. We are over a few minutes.